If the market dropped by 30% tomorrow, would your portfolio able to survive? And the most important question is that, do you have extra cash to buy the dips? Today I'm sharing my portfolio, the exact percentages that I hold, what ETF I'm holding, and the most important asset that most people ignore that gives me a peace of mind. So let's dive in. My name is Charan Lali and I've been investing in stocks and real estate from past 7 years, and now I make content on personal finance and investing. Now let's first talk about where we are right now. So S&P 500 and Nasdaq 100, they are at all-time high. So I hold SPY ETF, which is at $662, and I hold Nasdaq, which means QQQ ETF, and it's at $603. And these both ETFs are at all-time high. And some analysts are saying that this is just a soft landing. The economy will recover and we will have no recessions. And some analysts are saying the recession is coming sooner than you think, and we are really close to a recession. But I think the truth is that nobody knows what's going to happen. Nobody knows how long the recession going to take. Will it take 1 year, 2 year, 1 month, 2 months? But here's what I do know from the history. Market hit all-time high all the time. It's not a new thing. It had hit all-time high dozen of times in 2010, in 2021, 23, 24, and right now in 2025. It's not a new thing that market is at all-time high. And it's completely normal. And yes, there are some times when the crash happens after the all-time high. So there are some times when the all-time high, these are followed by some big crashes, like the dot-com bubble in 2000, the financial crisis in 2008, the COVID crisis in 2020. But the thing is, each time market fall, it always recover. But the truth is, not many people talk about it because they want to sell you the courses that market is going to crash, it's not going to recover for many, many years. But the market always recover. And the investors who are well diversified, who has an emergency fund, who has a cash that they can invest in the market is at the depth, they just stay fine even in a recession. But the lesson here is not that to avoid the market when it's all-time high. We need to learn here is that how to build a portfolio even when the downturn happens, even when the correction or even the crash happens, that our portfolio survive and we can make even gains in that recession. And that's what I'm going to show you today. Now I'm taking a number, $20,000 in my portfolio. It's not a real number. I have more in my portfolio, but just to make the things easier, just to know the percentages, I'm taking, let's say I have 20,000 in my portfolio and how I am splitting it into the stocks. So my first 30% and one of my core holding is S&P 500. And why I love S&P 500? Because it gives me exposure to the 500 biggest companies in US. We are talking about Apple, Microsoft, Nvidia, Johnson & Johnson, JP Morgan, all the big companies in US, they all are in S&P 500. So S&P 500 has given return of 10% every year. It's not 10% each year. Sometimes it's 24%, sometimes it's 20%, sometimes it's minus 20%, sometimes it's minus 10%. But if you look the past 100 years, S&P 500 has grown by 10% every year. So that's why I love S&P 500, because I know I'm going to get 10% return. And it has almost all the industries: tech, consumer goods, healthcare, energy. And if one sector struggles, the other one picks up. Now I know that S&P 500 is heavy on tech and AI right now. And I know if Nvidia, Apple, or Microsoft, they fell, whole S&P 500 will fall. But it has all the other sectors, all the other industries in it that will pick up in the future. And when you invest in S&P 500, you're betting on the strength of US economy, which will grow in the future. And historically, it's a winning bet. So I'm putting 3,000 or 30% in S&P 500. Now the second place I'm putting my money is in SCHD, and I'm putting 20% in SCHD. So 20% of 20,000 is $4,000. And if I have 50,000, so 20% is $10,000 in SCHD right away. So SCHD is United States Growth ETF. It gives you good dividend, and it has all the high quality stocks and companies that pay good dividend. And not only SCHD gives you dividend, the companies that are in SCHD, they have been growing their dividend from the past many years. You can think of the companies, they're boring, like Home Depot, Coca-Cola, Pfizer, Chevron. They're not a flashy growth stocks like Nvidia, Apple, Microsoft, but they're stable, they're profitable business that people still use. People still use their product when we are in a recession, so they continue to grow. And I remember in 2022, I have so much money in Meta, I have so much money in Apple, and when the crash happens, I have some money in SCHD. SCHD doesn't get affected by any recession at that time. So SCHD saves you when the economy crash. It holds up pretty good and it gives you consistent dividend. And basically two reasons I hold SCHD all the time. First is cash flow. So as I said, it gives you around 4% of dividend every year. So even when the economy is in recession, even when the economy is in good condition, I always get my dividend, and I always reinvest in SCHD, and I buy more shares, and compounding effects works pretty good in SCHD. And the second is stability. As I talked about before, in 2022, when all the tech stocks, all the SPY was down, the SCHD was pretty good. It was holding pretty good. It gives you consistent dividend because the companies that are in SCHD, they gives you good dividend and they're mature and they stay pretty stable. So that's why I'll invest 20% in SCHD. Now on the third place, I'll hold XDIV, and this 20% of my total portfolio. So $6,000 in XDIV. So XDIV is a Canadian ETF. It holds Canadian banks, pipeline, utilities, telecoms. So all the good companies that stay stable even during the recession. And I recently started my position in XDIV a couple of months ago. And the best thing is that it gives you a dividend 4% or more than 4% every year. But the question here is that why I am holding XDIV if I have SCHD. I'm Canadian. I invest in tax-free savings account. And I want good stable companies, good Canadian companies like banks, telecoms. I want geographical diversification because Canadian economy don't always move with US economy because Canada is not perfectly correlated with US economy. I want good stable companies like TD Bank, RBC Bank. I want utility companies. I want Fortis. I want telecom companies like BCE, TELUS. So that's all I can get in XDIV. So I just started my position. I look at the holdings and I like how the companies are profitable, how the companies are mature, they give you consistent dividend. And also the best thing with XDIV is it gives you monthly dividend. Like SCHD gives you dividend for 3 months, but XDIV pay you monthly. So I invested 20%, so $6,000 in XDIV for regular cash flow and stability and a trust in Canadian economy. And also with XDIV, I had an option whether to invest in international ETF like VXUS. So I just chose a Canadian. I'm Canadian and I had a broad exposure to the many good reputable companies. So I just chose XDIV over VXUS. And it gives you good dividend, it has good growth, so why not? Now we got 30% in S&P 500, 20% in SCHD, 20% in XDIV. So that's about 70%. Now left the 30%, and this is the most important. This let me sleep in the night. So 30%, 6,000, especially in this type of economy where there's a predictable recession, I'm gonna keep 30% cash in my portfolio. So $6,000 in cash in my portfolio. And let's say market dropped tomorrow by 20 to 30%. Who knows? It might be tomorrow, it might be next month, 1 year, 2 years. I don't know. The market might stay consistent. The market may fall down. So if I have 20 to 30% cash, if any dips happen, I'll like my favorite companies. Like I like Kava, I like Microsoft, I like Nvidia, I like Palantir. So there are many stocks I like. So that's why I want to have cash. So when the market fall, I can invest in my favorite companies. And it's different for everybody. If you're not like me, you can just buy S&P 500. If you don't want to do any research, when the crash happens, S&P 500 will also fall and it will recover in the future. But when it fall, you can always buy and use your cash that you have saved up. And I know many people will say that's a lot of money. You will lose your money 2 to 3% from inflation. But I rather lose 2 to 3% from inflation than losing in 20 to 30% when the market hits recession or when there is a correction in the market. So basically right now, I look cash as my insurance policy in my Wealthsimple account. So the good question here is that why I'm not holding individual stocks. So I just sold 2 weeks ago my Nvidia, my Apple, my Microsoft. I have few shares left, but I sold majority of them. So I have extra cash right now. So at that time, I felt it's more safer to invest in S&P 500 and SCHD rather than stay invested in Nvidia, Microsoft, and Apple. And also, when the market fall, S&P 500 right now is more concentrated on Nvidia, Microsoft, Apple, and all the other blue chip stocks. So let's say if the market fall 20 to 30%, S&P 500 will definitely fall, because it's considered of the stocks that I'm holding as well. And if S&P 500 drops, the other individual stocks that I'm holding, they will drop again. So right now, I want to stay invested in the companies that are mature, that has good reputation, especially the companies that are giving me dividend. So that's why I just sold my individual stock. I'm not asking you to sell everything and then just invest in S&P 500, but that's what I did. I sell Nvidia, I sell Microsoft, I sell a little bit in Apple, and just have extra cash or just invest in SCHD and S&P 500. And if you talk about recession, they happen every 3 to 4 to 5 years, and they're actually healthy for the economy. But the point here is that not to invest in when the market is at all-time high. The point here is that how I can build my portfolio that I can survive recession and have great returns when the market recovers. So I have S&P 500. I know it's going to fall when the recession hits. But I have SCHD, I have XDIV for consistent cash flow, and I have cash on site. When the market fall, I have resources to invest and have good gains in the future. And this is a bulletproof portfolio. It's here to survive. It decided to bend, not to break. And at the end, here's what I want you to take away from this video. First is, you don't need to predict the market. You just need to build your portfolio that you can survive even in a recession. Second is diversification. Don't put all your eggs in one basket. Have well-diversified portfolio. Third is discipline beats prediction. Consistent investing, reinvesting your dividend, have cash on site. That will beat trying to time the market. And the fourth is holding cash is not bad. It gives you option when the market dips and gives you a peace of mind. And if you like this video, please subscribe to my YouTube channel and give this video a thumbs up. I will do bi-weekly checkups on a portfolio, what I'm doing, what I'm selling, what I'm buying more to build my portfolio bulletproof. Thanks for watching. I'll see you on the next one.